Financial markets experienced a healthy rebound in October, and that follows a period of heightened volatility in August and September. In October, central banks were again at the helm, with the Central Bank of China and the ECB again reassuring markets by providing a very expansionary stance. The Central Bank of China acted, cutting interest rates, while the ECB announced that it will review the asset purchase program at the next meeting in December. Financial markets were reassured by the central banks, but also improved economic data in Europe and better than feared corporate results in the US provided a welcome upside to equity markets in particular. In this environment, hedge funds delivered a 2% return in October, following again a drawdown in August and September. Event-driven and global macro strategies outperformed as a result of their long equity positioning, while CTAs underperformed due to the fact that they cut their exposure to risk assets in the previous period, August and September, and did not capture the market rebound as a result. However, we remain overweight CTAs. The strategy is actively playing the divergence between the monetary stance in the US, where there is a hawkish bias with a likely first rate hike in December, and the divergence with the ECB, which is extremely dovish. And as a result, this has translated into an appreciation of the US dollar and another fall in commodity prices. So CTAs are long the USD against major currencies, and they are short commodities, so they are likely to benefit from this divergence in the monetary policy stance globally. We also overweight macro strategies, since their long exposure to equities and their long USD positioning should also benefit from the easing tone of global central banks. With regards to event-driven managers, they have rebounded in October following a difficult period in August and September. This is mainly the result of the good performance of the healthcare sector in the US. We think that event-driven may continue to rebound in the short term, so we remain overweight event-driven managers, but over the medium term, we have raised cautiousness, and we will likely turn neutral at some point in the coming weeks. Finally, we are upgrading European long-short credit to overweight. The strategy is likely to benefit from the expansionary stance of the ECB, which is likely to add corporate bonds to its asset purchase mix. European credit is benefiting from fundamental and technical factors. On the fundamental side, companies have deleveraged in Europe, and the default rates are extremely low. On the technical front, issuance is low, and the fact that the ECB is likely to purchase corporate bonds will support the asset class. So on top of the alpha generation by European long-short credit managers, this beta factor, the fact that the European credit market is likely to post solid performances, is supporting the strategy.